Ever stared at your TradingView chart, a sea of lines and colors, and wondered which one magic indicator holds the key to unlocking consistent profits? You're not alone. The quest for the Holy Grail indicator is a tale as old as trading itself. But what if I told you the answer isn't as simple as finding that one perfect tool? Think about it. The market is a constantly evolving beast, influenced by everything from global economic events to the latest tweet from a prominent figure. What works like a charm in a trending market might give you nothing but false signals during periods of consolidation. Relying solely on a single indicator is like trying to navigate a complex city with only one street sign. You're bound to get lost. So, if there's no single most accurate indicator, what should you be focusing on? The real power lies in understanding how different indicators work and, more importantly, how they work together. Think of your indicators as different lenses, each offering a unique perspective on price action. For instance, a trend-following indicator like the moving average can help you identify the overall direction of the market. A simple 200-day moving average, for example, is widely used to distinguish between bullish and bearish long-term trends. When the price is consistently above the 200-day MA, it suggests an upward trend, while price consistently below suggests a downward trend. However, moving averages are lagging indicators, meaning they confirm trends that have already begun. They might not give you the earliest entry or exit signals. That's where momentum indicators like the Relative Strength Index, RSI, or MACD come into play. These indicators measure the speed and change of price movements, potentially signaling overbought or oversold conditions and possible trend reversals. For example, an RSI reading above 70 often suggests an asset is overbought and might be due for a pullback, while a reading below 30 suggests it's oversold and could bounce. Similarly, the MACD line crossing above the signal line is often seen as a bullish signal. But again, relying solely on momentum indicators can be risky. In strong trending markets, the RSI can remain in overbought or oversold territory for extended periods without a reversal. This is where combining trend and momentum indicators becomes crucial. Another valuable category is volatility indicators, such as Bollinger Bands or Average True Range, ATR. Bollinger Bands, consisting of a middle moving average and upper and lower bands representing standard deviations, can help you gauge how high or low the price is relative to its recent trading range. Widening bands often indicate increasing volatility, while narrowing bands suggest consolidation. The ATR, on the other hand, simply measures the average price range over a specific period, helping you understand the market's volatility without indicating direction. Understanding volatility is essential for setting appropriate stop-loss levels and managing risk. Volume indicators, like on-balance volume, OBV, can provide insights into the buying and selling pressure behind price movements. Divergences between price and volume can sometimes signal potential trend reversals. For example, if the price is making new highs but the OBV is not, it could indicate weakening buying pressure. Ultimately, the most accurate indicator is the one that best suits your trading style, the specific market conditions, and, most importantly, is used in confluence with other forms of analysis. This could include price action patterns, support and resistance levels, and even fundamental analysis if you're trading over a longer time frame. Experiment with different combinations of indicators on a demo account to see what resonates with your strategy. Don't fall into the trap of constantly searching for the one magic bullet. Instead, focus on building a robust and well-rounded trading system. With that said, thanks for watching and until next time.